Hey there, it's John Downs here, and in this market update, it's April 15th. We have a lot to go over. So first, I'll get a little bit into mortgage rates and markets, kind of how they've been behaving. There's definitely some shocking things where I think a lot of people coming into this year were predicting a lot of Fed cuts. And we're actually seeing the exact opposite of that, at least as far as how the market is taking the strength of the economy and inflation. And now, of course, we have geopolitical events like we've experienced this past weekend. But then what does that mean for housing specifically? So I'm going to dive into my local market, which is the DC Baltimore Metro market. So of course, all the counties that sort of bracket those two cities and serve those local economies. And of course, anyone around the country looking at this, you can kind of overlay what I discuss and maybe look at those data points in your local market using some of the same resources that I'm going to share with you. So let's look at the 10-year bond. Mortgage rates historically have always tracked the 10-year bond, not being identical, but if you're an investor and you say, hey, I've got money to put to work, I want a bond, I want a safe investment, then one option is the 10-year treasury. And then a second option is a mortgage-backed security, a mortgage bond that probably pays you something more than a 10-year treasury. So let's just say that they move somewhat in tandem. And what I want to highlight here is last year, mid-October, that is right when the 10-year was at 5%. And then we just went down this cliff where to the end of the year, we improved 1.25% to 3.75 roughly. And the market in that moment, they were pricing in inflation dropping, economy slowing, and the Fed likely to drop rates up to 6 times in 2024. So as we roll into the new year, we start looking at economic data that comes in. How is the consumer spending during the holidays? How is hiring, employment, manufacturing, services, retail sales, all those things that drive the economy? Are they slowing or are they picking up speed? And sure enough, all year long, the data reports have been mostly outperforming, surprising to the high side. Not a lot of people losing their jobs, unemployment staying low, retail sales recently beating, oil pushing higher, inflation flattening. Basically everything you don't want to see if you want to see lower interest rates. So of course, we then started jumping up. And you'll see a lot of up and down movement, these little bounces. But this last move, I just want to highlight, here it is, April 10th. That's just a few days ago. We were at 4.3 and now we're at about 4.65. So just 3 or 4 trading days and 3/8% increase in rate. If you go back to where we were in maybe just exactly a month ago, we're about 0.625% higher in rate. So definitely something that is shocking if you're a home buyer, right? You wanted to see this play out. You wanted last year's rally of rates. You wanted to see that being consistent. So now the question is, what does this mean for housing? If interest rates are pushing higher, one, do we think it's going to continue? And two, how does that impact the buyer of today? So I want to dive into my local markets so you can just get a little glimpse into what is happening real time. Now, keep one thing in mind. This move, this 0.3% move, this was just in the last 3, 4, 5 days. So a lot of real estate data is lagging, right? So a few weeks ago, rates were a little better. There could be more activity. So will this increase in rate, will it throw some ice water on activity? Will we see different patterns in the coming weeks? I have my opinions on that, but let's just look at the data real quick. This is the Washington, D.C. Metro region. I'm looking at single family homes for now. Know that I'm going to put the links of all of these in the description below. You can hit the subscribe up top and actually get these delivered to you every Tuesday along with my commentary on markets. You can do that for each of these reports. Again, I will link them below. But what you'll see is that the inventory, which is what I like to track mostly to be sort of the predictive metric of where housing prices will go. So if you think supply demand, obviously supply is a big component of that. The demand can be muted. You know, we could have half the demand that we used to have, but if we have 70% less inventory, the balance is still towards a seller's market, sticky prices, higher prices. So I like looking at these. You'll see this little uptick. I like the 7-day average personally, and you'll see that we've been increasing. We went from just a few weeks ago, 3,000 units in the DC Metro area to about 3,700. But I want you to know that everything is seasonal. There's this natural move higher as we get into the warmer months. Almost every single year, if you go back in time, you will see very cyclical behavior. This is the time of year we expect inventory to rise. But to put it in perspective, 3,700 units today on average, pre-pandemic 9,000, so less than half. Now, down at the bottom of these reports, we have new units, which are new listings that hit the market, and then newly absorbed. How many went under contract? I like looking at that comparison. What is outpacing the other? Now, for the last few weeks, absorbed new contracts has actually been outpacing new units. So this week we have in the high-end homes, 2.3 million and higher, right? It's a big number. 112, which actually surprised me. New units on the market, 82 absorbed. And then you'll see once you get into that 950 range, that is more the local families of the DC metro area, single family homes, Montgomery County, Northern Virginia, parts of DC. You'll see 202 new units, 160 absorbed. As you go lower in price, you'll see that swing move over to more contracts compared to listings. That highlights the affordability issues of the market, right? A very strong first-time homebuyer market for the houses that are going to be more affordable. Now, within these reports, you have market action. So the higher the number, the more that is considered a seller's market, which also would lead you to believe that prices will be sticky at a higher level. But any of these that you want to drill down into, you can click this little tab and you can look at all the different days on market, price decreases. Again, you'll see cyclical behaviors in so many of these things. The Baltimore market, you'll see a little bit of an uptick here. And sometimes you look at these small timelines, you're like, whoa, look at that jump of inventory. And then you look at the historical chart and you're like, not really a big move. You know, right now, 1,500 units-ish, pre-pandemic, 5,300. So arguably less inventory in the Baltimore market. I generally will look at 3 primary counties in my market as sort of the drivers of the area. That's Montgomery County, Maryland, Fairfax County, and Annapolis, or Anne Arundel County. I live in Annapolis, so I like saying Annapolis. So Montgomery County, again, you're going to see so much of the same. It's actually quite sickening. So we only have 364 units today, pre-pandemic, about 1,300. So that's just 70% less inventory in that market, which is fascinating. And then new and absorbed, again, a little bit more balanced, but this is yet the first week I'm seeing more new than absorbed in a little bit of time. So something to focus on. Anne Arundel County, actually, this is probably the worst of all the counties in the area in the sense of inventory compared to pre-pandemic times, 273 compared to pre-pandemic 1,543. One could argue that the Anne Arundel County market became a hotbed of the commuters of both the DC metro market, DC city employers, as well as Baltimore City. You have the water, which a lot of people like. I'd say the school districts throughout the county are all very awesome, the public schools. So, for that reason, a lot of energy would kind of go and gobble up all the houses. The other thing is, I would say that market, Anne Arundel County, is more of what I would call a squatter's market. People move and then they just sit there for 20 some years. You get closer into DC, you find people are generally a little more transient. They'll likely move 7 to 10 years in a house, where it's not uncommon for me to talk to people in Anne Arundel County that are 20 years plus, or at least with those intentions. Fairfax County, a lot of the same. You just look at these median prices popping up, but inventory, same thing, a little bit of pickup, mostly seasonal, 420 units, pre-pandemic, 1,400. It's just crazy. New and absorbed, again, very balanced. And as you go lower, you see more activity, more absorbed. People need less expensive houses. And be sure to check out the video I did on why inventory is the way it is. Why is it so bad? Why is it so scarce? There are many factors, but I believe the factors at play in stable employment markets where you can't really just go out and build a whole bunch, I think this could very well be the new norm for quite some time. And there's things you can do if you're still looking into buying a house, but understanding the inventory situation, understanding what is likely to happen in the future. A lot of that can go into your framework about when to purchase, how to structure your offers, how maybe aggressive to be at the house you find that might be a 10 where you're going to hate yourself forever if you don't win it. I think a lot of the stuff that we talk about in that video, I think you'll find very interesting. And the last thing I want to show you here is our weekly newsletter. This comes out every Friday evening. It's a little nerdy technical, but very easy to digest. You can subscribe to it by just clicking that subscribe link. I will say I've had people read this for 10, 15 years. They absolutely love it. Most people really like just this chart right here. It's from Mortgage News Daily. It's a much better report than the Freddie Mac survey, which quite frankly is garbage. It comes out every Thursday. It's what the media uses. It's so wrong and so bad and so delayed that I find it useless for an indicator. You want to look at the Mortgage News Daily page. This is sort of an aggregate of a whole bunch of lenders, what you would call a 0-point loan with minimal adjustments. This is real pricing that lenders have. Now, really important thing to note is that interest rates are very different for everyone, whether it's your first home, depends on your income limits. Are you in the high balance space, so over 765,000 or not, credit score? There's just so many variables that go into your pricing that when you look at these average pricing metrics, you don't really want to look at that rate. You want to look at the direction of rates. Where are they going? Are they going up or down? And whatever we've quoted and shown you before, well, that means that if the general market is going up, then your rate probably goes up as well. And then, of course, on the way down. The reason I don't like the Freddie Mac survey is because they changed their modeling maybe about a year ago. And what they did is they took out the points. So you don't really know what the point structure is of the individual getting the loan. But if there was 1 week where there's just a whole bunch of first-time home buyers, their rates are actually going to be better. So as an average, it looks better. The Mortgage News Daily, it's going to incorporate real loans with 0 points. Now, I will say as interest rates get volatile, points generally go up. At least that's what we see and experience. So if you're looking at buying a house, sometimes you'll see lenders show you different point structures. And while over the years, I'm generally not a huge proponent of buying rates down in big ways, I do think looking at the recapture period and kind of making a judgment on how long do you think you're going to keep that loan? What are the refinancing costs? What are the loan adjustments when it comes time for you to refinance? And sometimes it just makes sense to buy it down now. So first-time home buyers not putting a lot of money down, buying condos, putting minimal down. If they buy the rate down, probably not a bad thing. Someone putting a whole bunch of money down on a much bigger loan, maybe they can lean towards 0 points. They probably get a higher tax write-off and the higher interest rate, and probably more likely to refinance more easily if interest rates and when interest rates correct in the future. So that's this week's update. If you have any questions, please ask some comments below. Always here to help. Have a great week.